Hi. Today we're talking about taxes. If you've been scammed in the world of crypto, you're definitely not alone. There's plenty of people who have been. So in this video series, I want to talk about how to handle this for your income taxes. And before we get into the IRS part of it, you need to understand what crypto is and how scams, especially involving influencers, have pulled in so many victims. And I think if we understand that, it'll be helpful to avoid it in the future. So with any analysis, especially tax analysis, it's important to understand how things actually work so we can determine the correct tax treatment. So with that in mind, and if you already understand all of the technical ins and outs of cryptocurrencies, you could probably skip forward to the tax part of this video. But I want to start with an explanation of what cryptocurrency is, how it comes about, maybe a little bit of history, so that you can understand a little bit about why the tax treatments are what they are. So cryptocurrency is a digital form of money that exists entirely online, but it's not backed by any government or bank, and it's traded on decentralized platforms, meaning there is no central authority in charge, and it's kind of scattered across the internet. It all runs on something called blockchain technology. So think of crypto as tokens with a value, kind of like digital coins. You usually buy and sell them through apps like Coinbase or Binance. There's more, but those are examples. So those are basically kind of like the stock exchanges of the crypto world. But unlike dollars in a bank account, these tokens aren't stored in a vault. They live on blockchains. And which blockchain they live on depends on the type of cryptocurrency you are dealing with. And if that's not complicated enough, each blockchain has its own ecosystem and its own rules. A blockchain is basically a big digital ledger, like an online record book. But instead of being stored in just one place, copies of this ledger are spread across thousands of computers around the world. And every time someone sends or receives cryptocurrency, the transaction is grouped into a block of data. And before that block of data can be added to a chain, it has to be verified, meaning a network of computers called nodes check the transactions to make sure everything is legit. So there's no double spending and no shady business. So think of it like a digital neighborhood watch. Before anything gets written into the book, enough people have to give it a thumbs up and say, yep, this looks right. Then once verified, the block is locked in and linked to the one before it, just like links in a chain. That's why it's called a blockchain. It's designed to be super secure and hard to tamper with, so people can trust the transaction's history without needing a bank to keep the books. So NFTs, or non-fungible tokens, are closely related. These are unique digital assets like artwork, music, or virtual trading cards that are bought and sold using crypto. So the idea is that you own a one-of-a-kind piece of something, and that ownership is recorded and verified on the blockchain. So I talk more about this in my video about Logan Paul. So a little history. The idea of cryptocurrencies started back in 2008 when a mysterious person or group using the name Satoshi Nakamoto published a paper online on a cryptography mailing list website called meltdown.com. This paper explained how to create a new kind of money that doesn't need banks or governments, money that people could send directly to each other over the internet safely and securely. That idea was built on a concept called cryptography. Cryptography is just a fancy word for ways to hide and protect information using math. It's what keeps your passwords, bank info, and messages safe online. With crypto, it's used to lock up each transaction so no one can fake or change it. Every transaction gets a unique code, and that code links to the one before it, creating a secure chain of records. That's a big reason people started trusting this new kind of digital money. It uses math, not middlemen, to keep things honest. Shortly after publishing the paper, Satoshi released the first version of Bitcoin software. This program allowed anyone with a computer to join a network and start mining Bitcoin by solving complex math problems. Mining is how new Bitcoins are created and how transactions get verified, all without any central authority like a bank. So to understand mining, think of it like digging for gold. Gold is valuable because it's rare. and hard to find underground. Bitcoin mining is similar, but instead of digging in the dirt, computers race to solve really hard math puzzles. The first one to solve the puzzle earns new Bitcoins as a reward. These puzzles are automatically created by the software to keep everything running fairly and securely. Mining takes a lot of computing power and electricity, kind of like how gold mining takes a lot of hard work and heavy machinery. Bitcoin was designed with a built-in limit, just like gold mines have a limit of how much gold can be found. For Bitcoin, only 21 million coins will ever exist. This cap was part of the original code written by its anonymous creator, and it's meant to mimic the scarcity of something like gold. The idea is that by limiting supply, Bitcoin could preserve its value over time and avoid inflation. New Bitcoins are created as rewards for miners who verify transactions, but the reward gets cut in half roughly every 4 years. A process known as halving. This slows the release of new coins and ensures the full supply won't be mined until around the year 2140. With over 19 million Bitcoins already in circulation, this limited supply is one of the reasons people view Bitcoin as a kind of digital gold. However, Bitcoin is a mined cryptocurrency, meaning new coins are created through a process called proof of work, POW. But that's just one flavor of crypto. There are several other types that don't rely on mining at all. It's important to understand what type of crypto you have because they are treated differently for tax purposes. I'll put a list in the description if you're interested in more details. If you're juggling multiple types of crypto, it's worth keeping detailed records and maybe using crypto tax software to track everything. Now, I just want to talk briefly about proof of stake, POS systems, which is a different type of system than a mined proof of work system. In a proof of stake or POS system, the network doesn't rely on miners racing to solve complex math problems like Bitcoin does. Instead, it chooses certain users called validators to confirm transactions and propose new blocks. So why would anyone want to be a validator? Because it's how you earn rewards in this kind of network. Instead of mining coins, you earn them by helping secure the system. Validators are picked based on how much crypto they've staked, basically how much they've locked up as collateral. The more you stake, the better your odds of being selected. But selection isn't guaranteed. It's kind of like a weighted lottery. Once chosen, a validator reviews a group of transactions and proposes a new block. If other validators agree that everything looks good, the block gets added to the chain, and the validator earns a reward. Here's the catch. If a validator tries to cheat, like approving a fake transaction, they can lose part or all of their stake. That's called slashing. And it's what keeps people honest. The whole system works because validators have something to lose. So in simple terms, validators are the referees who've put down a security deposit. If they call the game fairly, they get paid. If they cheat, they lose their deposit. That's how a POS system keeps the network secure without burning tons of electricity. Personally, I like to think of a validator as a contractor offering a service to the blockchain. Instead of submitting competitive bids, they stake crypto. Their bid is the size of their stake. The bigger it is, the better the odds of getting picked. But they don't get to choose the job. They just wait for the network to assign it. The incentive? Do the job right and you earn currency. Mess it up or act shady and you lose part of your stake. It's like putting up a bond before getting hired. Deliver and you get rewarded. Cheat and you get penalized. Now, depending on the specific POS system or blockchain, there may or may not be a hard cap on how much currency the system will release over time. If there is no cap, the currency is considered inflationary. What's made crypto and NFTs both exciting and risky is they're largely unregulated and easy to hype. That's where influencers have come in. In the last few years, we've seen a wave of online personalities pushing sketchy coins, fake NFT projects, and outright pump and dump schemes. YouTube, TikTok, and X, formerly known as Twitter, have both been flooded with promises about the next big thing in crypto. Most of these have turned out to be worthless, and many have disappeared overnight. It's tough to pin down an exact number, but estimates suggest, now listen to this, estimates suggest that thousands of fake or failed crypto projects have emerged over the years. Thousands of fake or failed crypto projects. I just needed to say that twice. One study analyzed 1,544 crypto projects between the year 2022 and 2024 and found a significant portion were either scams or failed ventures, with the US accounting for 43% of scams linked to projects and 33% of failed ones. Another report noted that during the 2017 boom alone, 80% of projects were identified as scams. 80%. And that trend has not slowed down. You would think that as much as people are getting scammed, that would slow down. But in 2024, 14.5 billion was stole globally through crypto scams. So now let's talk about Logan Paul. He's a high-profile example. As I have talked about before, Logan Paul is somebody who just does crazy things on the internet, and I think he's also a boxer. But he heavily promoted a project called CryptoZoo. That was an NFT-based game that never fully launched. Investors put in real money to buy digital eggs that were supposed to hatch into a hybrid animal. But the project stalled, developers walked away, and many people felt burned. Well, because they were. Paul later apologized and said he'd offer refunds, but lawsuits and investigations followed. And I have a longer video on this if you're interested in more of this story. Then there's this guy named Ben Armstrong, known online as BitBoy Crypto. I mean, why would anybody take advice from somebody known online as BitBoy? He promoted multiple crypto projects but has faced lawsuits because he allegedly accepted payments to promote these investments without clearly telling his audience. So investors lost money on many of these endorsements, and the lack of transparency matters because viewers may have thought they were getting honest advice when in fact he was being paid just to advertise. That's why he's really facing serious legal trouble for misleading people who trusted him and lost money. But BitBoy, come on. So another example was Dave Portnoy. He's the founder of Barstool Sports, who became a major crypto influencer by loudly supporting various cryptocurrencies and projects. While he has not been accused of fraud, he's been criticized for promoting highly volatile assets without fully explaining the risks involved. His bold and sometimes erratic opinions have fueled debate about how much responsibility influencers really have when talking about financial products. These aren't just online drama stories. In many cases, they've led to real lawsuits, financial losses, and people getting scammed out of their life savings. So if you've invested in one of these influencer hype projects and ended up scammed, what can you do when tax time rolls around? We're going to talk about that. The IRS treats cryptocurrency as property, not as a regular currency. That means it's taxed kind of like stocks or real estate. So when you sell your crypto for cash, trade one crypto for another, or use it to buy something, that's a taxable event. You may owe taxes on any gains or possibly be able to claim a loss if you sold it for less than you paid. If you received crypto through mining, staking, or as a payment for work, that's treated like regular income based on its value at the time you received it. So there are actual markets like Coinbase and Binance and CoinMarketCap and others where you can check the real-time value of your crypto just like you would for stocks. Some activities don't trigger taxes at all. For example, just buying crypto with US dollars isn't taxable. Holding onto your crypto without selling it or moving it between your own wallets also doesn't count as a taxable event. But when you do file your taxes each year, there's now a yes or no question that asks if you had any digital asset activity, and you're required to answer it honestly. Starting in 2025, this year, crypto exchanges will be required to send out new IRS forms called 1099-DA. DA standing for digital assets. This will show how much money you made from selling digital assets. But even with that form, it's still up to you to keep track of how much you paid for your crypto and to report your profit or losses using the correct IRS forms, like 8949 and Schedule D. The amount of tax you owe depends on how long you held the crypto before selling it. If you held it for a year or less, any profits are taxed just like your paycheck, as regular income rates, which can be pretty high depending on your tax bracket. But if you held it for more than a year, you may qualify for lower long-term capital gains rates, which range from 0 to 20% depending on your income. So if you're earning crypto through things like mining or staking, the second it hits your wallet, it's considered income, and that means taxes are due. That's why keeping good records is key. You need to know exactly what you got, when you got it, and what it was worth at the time. Now let's talk about losses from certain types of scams. It's important to understand the difference between cryptocurrencies like Bitcoin and in-game tokens such as those used in CryptoZoo. Real cryptocurrencies exist on public blockchains and can be transferred between wallets or exchanged for cash or goods. In-game tokens, however, are often limited to that game's ecosystem and cannot be withdrawn or traded outside the game in the same way. The IRS treats these in-game tokens differently, and losses related to them may not be subject to the same tax rules as traditional cryptocurrencies. For example, if you own a CryptoZoo egg or token that you cannot burn or otherwise dispose of in the game's mechanisms, you cannot take a loss on that decrease in value or worthlessness of the NFT or token while you still own it and the website or game is still available. However, there are still steps you can take to potentially claim a tax deduction for the loss. According to IRS Chief Counsel advice, simply holding a digital asset that has dropped drastically in value does not qualify for deduction. The IRS requires that a taxpayer take an affirmative, identifiable action to fix the amount of the loss. This means you need to either sell, exchange, or abandon the asset in a way that clearly shows you no longer have any rights or expectations of value from it. So, in the absence of a built-in burn feature or functioning marketplace in CryptoZoo or any other ecosystem, this may be challenging, but there are some practical workarounds. If you are unable to burn or sell an NFT within an ecosystem, you might be able to get your deduction on its decrease in value by posting a clear, dated statement on a platform you control, such as your website or social media. This declaration should state that you relinquish all ownership rights to the NFT, acknowledge its functional worthlessness, and confirm you will no longer assert any claim or expect any compensation from the NFT. Taking this step helps establish your intent to abandon the asset, a key IRS requirement. Additionally, you should document and retain records of this statement for your tax files. Beyond the declaration, an effective way to satisfy the IRS demand for an affirmative act is to use a third-party tax loss harvesting service. Now, if you are trapped within an ecosystem, you'll need to verify that you can do this. But tax loss harvesting services that specialize in NFTs exists. These services will purchase your worthless NFT for a nominal amount, such as a fraction of a cent, thereby creating a documented sales transaction. This sale serves as an identifiable event that fixes your loss, making it easier to claim on your taxes. Alternatively, if your NFT is transferable, you can send it to a known burn address, an address from which the token cannot be recovered, effectively removing it from your ownership and providing evidence of abandonment. You should do at least one of these things. So, always remember to keep thorough documentation of all steps taken, including screenshots, transaction records, and the date-stamped public statement. Given the complexity and evolving nature of digital asset taxation, consulting a tax professional experienced with cryptocurrency and NFTs is strongly recommended to ensure compliance and to optimize your tax position. Now, what if you want to take a tax loss and join a class action lawsuit to try and recover some of your losses? Here's the thing. To claim a tax deduction for an abandoned asset like a worthless NFT, the IRS generally expects a clear, irrevocable act of abandonment, meaning you've given up all rights and expectation of future value. That's why some people publicly burn NFTs or transfer them to unrecoverable wallets to demonstrate abandonment. Now, if you join a class action lawsuit with the expectation of some sort of recovery, it's unlikely that you would undermine your position unless the action sought to explicitly recover cost or market value of the asset. In that case, it could potentially undermine the claim that you truly abandoned the asset. The IRS might argue that you haven't fully relinquished your interest if you're still pursuing compensation tied to that NFT. That said, it's not always black and white. If the lawsuit focuses on fraud or misconduct and your claim is for damages unrelated to the NFT's residual value, like deceptive marketing or securities violations, you might still be able to argue that the NFT itself is worthless and abandoned. even if you are seeking restitution for other harms. But here we always want to talk about playing it safe. So you're going to document your abandonment clearly and try to separate your tax position from your legal claim. The IRS is paying more attention to all of this, and starting in 2025, they're tightening reporting rules and requiring more disclosures to make sure crypto profits and losses don't fall through the cracks. Brokers will need to report gross proceeds from crypto sales on that new 1099-DA form, which is supposed to help the IRS track what's going on in the digital asset world. So if you got burned in a crypto scam, your best move is to collect everything: your records, screenshots, emails, anything that proves what happened, and bring it to someone who understands both crypto and tax law. Crypto isn't just a trend. Whenever we have new financial frontiers, it's usually a playground for scammers, especially since it's not really regulated. Make sure to vet the people who you are investing your money with, and don't take your advice from a financial influencer. That's not the right place to get your financial advice. Well, that's it for now. Thanks for watching. Please like and subscribe, and I'll see you next time.